Yeah, this chapter deals with how do I use the hedging strategies if I have to hedge my portfolio or if I have to hedge my position. How do I use the various types of futures for doing that kind of a process? So, just to understand the basic concept, the long hedge versus a short hedge. If I'm saying long hedge, basically I am playing a long, I am entering as a long in the futures market. I am getting into buy position in the futures market. If I say short hedge, I am entering into a short position in the futures market. I am entering as a seller in the futures market. When will I enter as a seller in the futures market? If I already have bought something, if I already own something, I expect that the price of it will go down because we are thinking of hedging strategies here, no speculation. I have already bought something. I am assuming that the price of it is going to go down in future. I am trying to reduce my downside. So I am entering as a seller in the futures market. That is where I am calling as a short hedge. So from a short hedge standpoint, the intention is to mitigate the downside price movements because even if the actual asset goes down in value, the short position in the futures market will gain in value. Overall, there is a compensation. So I am not losing much bigger. So especially when you foresee that any asset price is going to drop in future and you are holding that asset, you enter into a short futures kind of a position. Similarly, the long is exactly the opposite. When you think that the prices are going to go up in future, you will take you will take a position to protect yourself. Let's say a company, it requires some X product. X is a raw material for it, right? It requires X as a raw material. But today, if it buys it, probably it has to store it. There are so many headaches associated with it. So it requires, let's say, after 2 months or after 1 month, right? But it is expecting that the price of it will go up in future. So it does not want to buy it at such a higher price. So if it wants to hedge its risk by locking the price, it can enter into a long hedge kind of a position. So whenever entering into a position is primarily to mitigate your risk, whether you are entering into a long position or a short position in the futures market, if the intention is to mitigate the risk, we are calling it as a hedging kind of a position. So the long hedge is always appropriate when you are thinking that the price of the asset will go up in future. The short hedge is more appropriate when the price is going to go down in future. This one single task you can very well take it for any kind of asset, commodities or exchange rates or any kind of stuff. If you are expecting that the price is going to go up in future, you will enter as a long position because that's your expectation. So you may expect that it will go up, I may expect that it will go down. So you will enter as a long, I will enter as a short. That's how the tradings happen, right? Just like any other. If you are a buyer, I am a seller of any good, you feel that buying at that price is appropriate, I feel selling at that price is appropriate. You feel that, oh, buying at that price is an advantage to me. Seller feels selling at that price is an advantage to me. In reality, only one person will have an advantage. But we think we are at an advantage. That's where the trades happen. That is how even this trade is typically happening. So, hedging wise, benefits we have been thinking of, we have been discussing at decent length. It reduces the price uncertainty. It is locking the price. We are locking the price of the transaction 1 month later, but by today itself, locking the price today itself for a transaction which is bound to happen after 1 month, right? And either in a long position or a short position, I can take that kind of a scenario. So my volatility about the profitability is actually reduced. Otherwise, probably I may gain very heavily, I may lose very heavily. But here, gain or loss is very limited. So that uncertainty around the profitability is what is being reduced. But at the same time, the other side also compromise on the profitability. That's again an argument that is going against the hedging. Wherever there is a scope of making profits, too much of hedging is eating up your potential of making profits also. So because even if the asset is gaining a value, if you had not hedged, probably this much would have been your profit. But because you have hedged, this hedged one will actually go down in value. Overall, you are losing out. Or your losses, your profits are coming down. Though your losses are also coming down, your profits are. So when there is a potential to make profit, you don't take advantage of that because of your risk management process, because of your hedging process is actually eating up the profits of the company. And even as I said, individual shareholders, they do their own risk management through portfolio management. They create their own portfolio. So if all companies are becoming no risky kind of stuff, for an individual shareholder, he may not come forward to invest in them because he wants to take a risk. He wants a better returns. He wants to take a risk. But at the same time, he has his own individual mechanisms of diversifying. So if that is the case, when an individual is able to diversify to some extent, the company is diversifying their risk is like an overkill, which the shareholders may not be interested for. So that is again an argument that is going again. And in some industry, probably the prices can change completely dynamically based on the exchange rates or based on the input raw material prices increase. Even your output prices also keep going up and down, right? When the, let's say for your exam fee itself, if the price keeps changing constantly with the exchange rate, probably there is no reason to hedge. But if the price is constant but the exchange rate keeps fluctuating, there is a reason to hedge. You want to fix the price, you want to reduce the uncertainty in the process. So wherever you see that the price changes drastically, the moment the input rates are changing, let's say the petrol, the moment the crude oil rates rise in the industry, in the world, if the petrol price also goes up, and if the crude oil price falls, if the petrol price also falls, there is no need to hedge. Because anyhow that change is taken care of. So in those cases, there is no need for hedging. But where you see that there is a constancy on one side, but there is a lot of volatility on the other side, that is where hedging plays an important role. Now, the one important thing that we have to look at in this context is, what do we mean by a perfect hedge and what is an imperfect hedge? And when we say, let's say I want to hedge my portfolio. See, I already have a portfolio of a few $1,000,000. So if I already have a portfolio of some $100 million, I want to reduce the risk on that. So if I have to reduce the risk, I need to get into a futures contract as a short position. Because if I already own $100 million portfolio, the risk is that value will go down. So I am getting into a short position in the futures market. Now, is there a guarantee that exact replica is available in the futures market? May or may not. Right? Let's say I have my portfolio of 100 million is, or probably let's say I have held, why so complex? Let's say I have held I have purchased some type of oil. Some 1,000 barrels of some type of oil is what I have purchased. Now my risk is the price of it will go down in future. Right? So I want to hedge it in the futures market. There is no guarantee that the same oil is traded in the futures market, right? Probably some other oil is traded in the futures market. The oil which I am having, let's say I have olive oil with me, but no olive oil futures are available in the futures market. Only if I am able to trade olive oil futures in the futures market, then only it becomes a perfect hedge. Because whatever the fall in the olive oil price here, I may expect an equivalent increase in the olive oil price in the futures market, which will offset my total risk. But if I don't get an olive oil futures in the futures market, I may compromise with something else, right? That's one aspect. Then it is not a perfect hedge. The other scenario, let's say I have purchased olive oil, right? But I want to hold it for the next 1 year. I'm selling it off to you after 1 year, right? For this 1 year, I don't know whether the price is going to go low. If it is going to go low, it's a risk for me. So assuming, let's say, olive oil futures are available in the market, but they are available only for 3-month maturities. At the max, I have up to October or something, but I have to protect my price until the next July. But the futures contracts are maturing in October itself. The largest possible that is available on the exchange is a maturity of October itself. How will I do the protection up to July? Even that is a risk. Even if olive oil futures are available on the exchange, their maturity periods could be different. This I want a 1 year protection because I am disposing of my oil only after 1 year. Whereas the futures market is available only for a 3-month maturity. After that, again, I may have to enter into another contract and protect up to 1 year. So in that case, the prices may be increasing, may be decreasing, all are possible. So that is where we don't talk about a perfect hedge. It's very rare to get a perfect hedge, right? It's very rare in reality to get a perfect hedge.